Hi, everyone. This is Daniela Cambone for StansberryInvestor.com. And before I bring you today's interview, I just want to share with you a report we have just put out that I highly urge you check out, because with most investors going about life, investing, and retirement planning as if nothing unusual has happened to our financial system, not realizing the repercussions of the 11 trillion that's been pumped into the US financial system in the past 18 months alone, it's especially a good read at this moment in time. At least 4 billionaires have stated publicly that Americans aren't paying enough attention to this development. And now a former Goldman Sachs banker says sooner than most people think, millions of Americans will potentially be pushed down out of the middle class, out of private retirement, and out of a decent life based on independence and privacy into a collectivist nightmare he calls financial lockdown. So find out how to protect yourself, your money, and your family with a free copy of his new report. In it, he'll show you the 4 steps he recommends that you take immediately. So if you'd like a free copy of the report, you simply have to go to wakeupcall2021.com. Again, that's wakeupcall2021.com. Today, we are catching up with Lawrence Lepard. He is the founder and managing partner over at Equity Management Associates, and he will be helping us decipher what the Fed said this week, what it will do next, and what it means to your bottom line. Please welcome back to StansberryInvestor.com, Lawrence Lepard. Lawrence, always good to see you.
Thank you, Danielle. Yeah, it's been too long. I really enjoyed talking to you. We've had some good talks.
Absolutely, same here. And help us make sense of what is going on in Fedland, because they've hinted at a taper. The markets have taken it in stride, really. But you say, forget the taper. It can't happen.
Well, there's that. And I mean, it's, look, this is so confusing. You say, hey, give me a clear explanation of this. And I wish I could, but I can't, because there is no clear explanation, because they want it to be confusing. I mean, they intentionally, are trying to keep the market off balance. And that's the game they're playing. It's kind of a peas and shells game. Yeah, they've talked about tapering. Will they? I don't know. I do know that at a large policy level, they absolutely need to have inflation, or the economy is going to blow up. So they really need inflation. But in turn, what happened in this last round is we had way too much inflation, and they thought, uh-oh, we better tap the brakes. And so they're tapping the brakes right now. And whether they stomp on the brakes, I think that's impossible. If they did, the regular stock market would blow up, and the economy would tank, and they know that. So they're fooling us by tapping the brakes is kind of the way I see it, and they can change their mind. I mean, he laid out a plan for tapering, and my view is he did that because he knew he had an inflation problem. I mean, we all look around us and see what's going on with inflation. It's a serious issue, right? So that's what happened.
And I like how you said, offline, they basically have to inflate or die.
Right.
Right. So just talk to us a little bit about what they want to maintain, a certain level of inflation. They obviously don't want a hyperinflationary environment.
Correct.
How does this play out in your
opinion? Well, it's hard. It's going to be, they're like bouncing off the guardrails. They're going to be zigzagging, right? When inflation looks too hot, they're going to give us this, hey, we're tapping the brakes. No, we're going to withdraw, et cetera, even if they may not. And then, if things get too soft, they're going to turn around and say, oh, no, we didn't really mean that about tapering. So yeah, the inflate or die is an old line by Richard Russell, and it really is true. I mean, when you've got debts that are 130% of GDP the way they are today, every other country in history that's gotten into this kind of a debt trap, those are the only 2 ways out. Either you default and the debt becomes worthless and your economy, you go into the depression, or you print the money to make the debt lower in nominal, or lower in real terms by making the nominal numbers bigger. So they need to have inflation. In turn, they know that too much inflation is political death. So they're trying to walk this very thin line between too much inflation and the obvious deflation that would occur if they really do taper, which at the end of the day, I don't think they will. But, they've got everybody scared that they're going to taper. And, they've also got all these workarounds. I think it's important to observe. I mean, I'm on Twitter, and one of the greatest guys on Twitter is Luke Groman. And he points out that what they're doing is they're saying they're going to taper. They're taking away the heroin of the QE, but in turn, they've got all these other methods for putting money into the system. I mean, they've got a standing repo, facility, which, injects money as much as is needed. They've canceled the net stable funding ratio. They're they're doing things to put money into the system, even though they say they're not. And, you know, what they're doing, you know, the Fed basically is just a big jawboning operation. And it's trying to get the markets to stay somewhere in the middle so that, you know, the economy doesn't tank and we don't have hyperinflation. But
right.
the numbers are such that everything is so extreme now that one misstep and we could really go into either of those two conditions. And I think they know that. And so,
yeah,
you know, having said that, they are able to put us off foot. You know, we talked before, and I think where you might be going with this is, what does this mean for gold? And, you know, everybody's very frustrated. Why hasn't gold gone through 2000?
Hold that thought. Hold that thought, because I'm going to get there. I'm going to get there.
Okay.
But first, I have a lot of questions. I'm very, very excited right now. Okay, going back, just staying on the Fed for a second here.
Yeah.
Lawrence, I had another guest on earlier this week who was basically saying, you know, we give too much credit to the Fed where we think they have all this power, but in fact, they're just reactionary. I'm hearing the opposite from you, that you in fact think they hold the control.
Well, they hold the control of the narrative. And unfortunately, a lot of, you know, the investment community buys the narrative. I mean, there are polls that show that 70% of the people buy the transitory inflation lie, which is, you know, a blatant lie. I mean, this inflation, in my opinion, we have turned the corner. This inflation will not be transitory. And they're also somewhat reactive. I mean, I remember it very well back in 2008 when we had the GFC and they came with TARP. And the first time they came in, they put it up to Congress, you know, we're gonna print $800 billion to bail out all these financial institutions. And Congress looked at each other and they got overwhelming, you know, 90-10 opposition to that from, you know, no bailout, right? And so the first time TARP went up, they denied it. They said no, you know, and of course the stock market sold off, and it sold off hard. And so they brought it again, and guess what? They approved it. And so what, you know, this is the bouncing off the guardrails analogy that I used earlier, right? I mean, they'll push you in one direction, but then when that gets too out of control, they'll quickly react and come in the other direction. I mean, hell, in 2019, you know, they were 18-19, they were tapering, but then the market got soft, you know, the repos blew out to 10% and they did a complete U-turn. Yep. You know, so yes, they do have control of the narrative, but they also tend to, you know, sometimes they wait for things to get extreme and to react, because they know that if they do it preemptively, the politicians will get after him. I mean, the one who's getting after him right now is Manchin, right? He's saying, "Oh, I'm not letting this MMT 3.5 trillion thing go through, and we can't spend that. We'll have an inflation problem," right? But and so fine, they're not. But guess what? You know, the minute the stock market's off 15%, you know, you're going to see MMT out the yin yang. I mean, it's gonna, you know, they're gonna turn around and do whatever they need to do, because a severely falling stock market is going to create a lot of trouble for them.
All right. So. And to that point, let's talk to middle class, okay? Because I understand they need to keep the stock market or the illusion of a market afloat here, right?
Right.
But on the other hand, inflation, you know, we have prices going higher here. At least I certainly feel it here in New York City. Yet salaries for most folks are not going up. So aren't you creating a bigger problem?
Oh, yeah. No, I mean, potentially a revolutionary kind of thing. I mean, although some salaries are going up, I mean, you do see wage pressures, and, you know, we've got 11 million job openings right now. So, you know, that's the thing that's going to have to give. And that, frankly, is part of the reason why I think that the inflation is not just a transitory thing. I mean, when you increase somebody's salary, you don't take that back. That doesn't go away. Yeah. And then they get used to it and they want more, right?
It's just that, you know, I mean, not even just in New York City, even just when I was in Montreal, I mean, a trip to a pharmacy now, Lawerence, you can't get out of a CVS without spending $100. Like, what's $100 these days?
Oh, I know. No, it's yeah, we all have anecdotes. It's insane. I mean, what used to cost $50 to $75 at the grocery store a year or two ago now feels like it costs $150. You know, it's horrible. It's horrible for everybody, you know.
So let's talk about protecting ourselves in this environment. I always like to bring it back to this. I know you're a big gold fan. You're a big advocate of holding gold. But the question is, and I've posed it to other guests, and I can't wait to get your take, is why is gold not above $2,000 an ounce here, given the economic environment here?
Two words: paper gold. I mean, that's the biggest thing. I mean, they've got the gold price locked down. I mean, it's insane. Every other commodity in the world is at record highs and screaming higher, and gold is below its all-time high of last summer. I mean, it's nuts. And I say gold, I mean, I really mean paper gold. I mean, if you go try and buy physical coins, you see enormous premiums. So, you know, that's one reason. The other reason is we have had a nice big run. I mean, if you go look at my Twitter feed, I just posted a 30-year or 20-year chart of gold. I mean, recall that as recently as 2018, 2019, gold was at 1,300. I mean, it touched 2080 last summer. That's a hell of a run. I mean, and it kind of anticipated the inflation that was coming. And arguably, maybe it got a tad ahead of itself. I mean, I don't think it did, but one could argue that, you know, all markets breathe. And I think one of the things that gold people have to do here is kind of take a little bit of a longer term perspective, and, you know, kind of calm down and not worry about the fact that we're, you know, 15% off the all-time high. I mean, okay, so we went up to 2080 and now we're back at, I don't know, today it got hit again, but sort of in the 1750s. We used to be kind of in the 18 range, but you know, that's not the end of the world. I mean, that's, you know, on the back of a, you know, a gold price that was $1,300 a few years ago, you know, that's a very normal correction. And so I think everybody has to just relax a little bit and realize that we are on the right side of this trade. You know, right now you've got mean Fed, you've got bad cop Fed. Oh, we're going to take away the liquidity. Oh, we're going to prevent inflation. Oh, you know, Manchin said, oh, we're not going to let this 3.5 trillion go through. You know, we're going to be responsible. So, you know, all you guys who are betting on gold and crypto, you know, no, you don't want to be doing that. We're going back to this 40-year deflationary world that we had, you know, and that's the narrative, right? That's what they've created, you know, and so people listen to it somewhat, right?
So, you know, you're saying gold is treading water right now. And, you know, once it does get over 2000, we could see fireworks. But what do you think would be different this time around? Why didn't those fireworks hold last year?
Well, they kind of did. I mean, remember that markets are anticipating what's coming a little ways out. And so, you know, right now the market has not figured out that it's not transitory, and the market has not figured out that the Fed is trapped, or I should say a preponderance of the market. I mean, we figured it out and gold holders have figured it out, and we're not selling. But at the margin, people are buying their narrative. And so it's come back in. What's broadly different from, you know, the last gold correction back in 08, you know, or 11 to the bottom in 2015 is that, you know, we're sending money directly to people. We're monetizing much more of our fiscal deficits. You know, there's just the money growth. I mean, the money growth numbers are really amazing to me and not focused on enough. I mean, in 2019, barely 2 years ago, you know, M2 was 15 trillion. Now M2 is 20 trillion, 21 trillion. It's 35% growth in 2 years. I mean, you know, we increased the money supply 35% in 2 years. I mean, we've been around as a country for 200 years. You know, a related thing is the Fed balance sheet. I mean, the Fed balance sheet in that same time frame went from 4 to 8 trillion, you know, and back when the GFC occurred, the Fed balance sheet went from, you know, 1 to 2 trillion on the first blush, and then it went and climbed up to 4. So it doubled again. So if you double today's Fed balance sheet again, you're going to go to 17 trillion, you know, over the next few years, which is just, you know, it's crazy. I mean, that's the size of the economy. So, you know, we know the inflation is there. We know it's coming, you know, but we've got to be patient, and we've got to understand that, you know, nothing moves in a straight line. You know, that's just the way it is, right?
So Lawrence, talk to me a little bit about your positioning, like cash via gold, like in terms of what percentage you like holding there.
Yeah, I almost never hold a lot of cash. It's probably a mistake. I tend to get a conviction on an idea and just go for it. I mean, look, I mean, everyone's different. You know, I think gold is the safest long-term hold form of money in the world, bar none. It's like what people used to consider bonds to be, or government bonds, treasury bonds to be. I mean, you know, it will protect your purchasing power. You own it in your own hands, or it's something that you can get access to. You don't own paper gold because that's all going to blow up. You know, then, you know, if you want to have a little bit more spice, then you go for silver. It's more volatile. It's the same trade, but it's a little more volatile. And then the mining stocks, and that's what my fund manages, or my fund does. We invest in gold mining stocks, which, you know, really swing, right? I mean, this is a risky business. It's a hard business. You're breaking rocks. You got to replace your reserves every year, et cetera. But having said that, you know, you can, if you get it right, you know, you're not making 10% a year, you're making 100% a year or more. And so, you know, right now you're seeing just incredible. I mean, it's like you're getting a do-over in the gold stocks. I mean,
Yeah.
last August, I had investors saying, oh, I missed it. You know, last year was up 125%. They're like, well, it's too late. I'm not going to buy the gold stocks. Well, guess what? You just got, you can get a big discount right now because
right now, right.
Yeah. I mean, I've got gold stocks, Danielle, in my portfolio. I've got gold stocks. I've got big, well-known name gold stock. They're selling at 2.5 times their cash flow, their EBITDA, their cash flow. That's a 40% yield. It's crazy.
But so let's talk about the mining space that's getting crushed right now, Lawrence. Yeah. But as you say, it's a buying opportunity. Why the pressure on the miners? I mean, at 1,700 gold, it's still a good operating price for them.
It's a great point. I mean, I was trying to say that to people who I was just at Denver and Beaver Creek gold shows. I mean, the miners in general are kind of like, hey guys, this isn't so bad. You know, I mean, if somebody 2 years ago had said to us, we were going to be at $1,800 gold in a few years, we would have said, hallelujah, that's the best thing ever.
That's right.
You know, and so we're at 1,750, 1,800 gold. I mean, miners are making a lot of money. The industry average ASIC is $1,000. I mean, you're making 800, you know, you're making $800 on an $1,800 sale price. That works. It completely works. You got big cash flow. So the miners are fine. Now the stocks, on the other hand, what the stocks are doing is the stocks are accentuating the narrative that says, oh no, inflation's not, you know, not persistent. It's transitory. It's going to go down. And I saw a lot of people there from Toronto and other places building models where they said the future gold price would be 1,650. There's just no way. There's just absolutely, in my opinion, there's just absolutely no way we're going to lower gold prices than where we are roughly now. You know, we're going to 2,000 and then we're going to 3,000. And when that occurs, it's going to be outstanding.
But right? Even Lawrence, even if it were to go to 1,650, heck, even if it were to go to 1,400, aren't most working with an all-in sustaining cost of 800, 850, 900?
Yes, that's exactly right. I mean, it's, you know, look, if it were to go that low, some of the marginal companies would have serious trouble. And there are marginal companies, right? But the average gold company would be absolutely fine. You know, they've had a long time where they've cleaned up their balance sheets, they built cash balances, you know, et cetera, et cetera. They know how to run these things well. And they've shown capital discipline. So for the first time in a long time, the gold companies really are in an outstanding position. And more importantly, they're cheap. And, you know, they're cheap at today's gold price, and they're going to be, you know, super cheap, you know, at future gold prices. I mean, looking at my portfolio, looking at the good names that we hold, I think we have 2, 3, 4, 5 baggers laying around all over the price. Not if we stay at $1,800 gold. If we stay at $1,800 gold, you know, my sense is, and the multiples don't expand, my sense is, you know, we could earn 30% a year on these companies as they grow their, you know, they grow their production. But, you know, if we get to $2,000 gold and then to $3,000 gold, I mean, these things are going to explode to the upside, absolutely explode.
So is your main focus the juniors, Lawrence? Is that where you?
It is. I mean, I have some of the majors though too. So you know, my main focus, my job, what I've been tasked to do is to try and earn good returns for my investors, which is what I work at every day. And you know, I move around. I'm not wedded to any one specific part of the market. I mean, as you know, there are developers and drill stories and seniors and juniors. And yeah, the sweet spot tends to be the junior that has production, has positive cash flow, has a mine or two operating, and is using the cash flow to build mine number 2, 3, or 4. So they're growing their production, you know, and they sell at a low multiple of cash flow. That's a very powerful combination because a higher gold price would mean profits will go up. Additional production in future years means they'll have, you know, bigger profits just on the number of ounces they're selling. And then we're going to get multiple expansion. I mean, if they're selling at 3 times, you know, cash flow today, and this becomes a hot area, which I think it will when gold breaks over 2,000, you know, those multiples are going to expand. They're going to sell at 6 times cash flow. I mean, I remember 2011 when things were selling at 15 or 20 times cash flow. Now they were overpriced at that level. But the point is, if we go from a multiple of 3 to 6, there's a doubling, even if you didn't have a higher gold price or you didn't have more production, right? So you can see the math of how we get to, you know, doubling, tripling, quadrupling your money. It's not crazy. I mean, this is not a pipe dream. And we need higher gold prices for sure, but it can happen.
Well said, Lawrence. And just final point, I like how you've said this to me offline, you know, talking about assets and how to diversify and protect yourself in this environment. I hear you, gold for you is your top pick. And as you know, Bitcoin also comes up as the other asset. And you said, hey, stop pitting these two against each other.
Yeah.
They're on the same team.
Yeah.
But state-controlled money is the enemy.
Exactly. And by the way, the state is who keeps messing us up. They keep changing the damn rules, you know, and they keep ruining the narrative. I mean, these people are bad, bad people. You know, they're causing, I just have to say it. It's a fact. Yeah. They are causing the middle class to suffer. You know, for Jay Powell to say that the Fed doesn't create wealth inequality, that's just complete and utter bullshit.
Is this the worst Fed for you, Lawerence, that you've seen?
That's a tough contest. They're all pretty damn bad. I mean, I mean, somebody says, who's the worst Fed governor? I mean, honestly, I think the guy that, I mean, look, Jay Powell's pretty bad, but to me, the person who was kind of the intellectual forefather of this, a little bit, it was Greenspan, but when Ben Bernanke did his helicopter speech and basically said, hey, look, you know, we can print as much as we need with no consequences. That was just a really, really
that really, thing. I agree, ushered in a new era of Fed.
Exactly. That's what started this whole thing. And by the way, the Washington politicians, I mean, they're just the guys who look in the rearview mirror. And I mean, even Cheney said deficits don't matter. Well, you know, I've long said the way that, and this is my New Orleans speech, the way I look at this is, you know, these fiat guys, these are the guys who jumped off the 100-story building and said, I can fly. Okay. And they're flying right now, but they're getting close to the lower stories. Right. And, you know, they're saying so far, so good. And I see the splat. It's coming. You know, it's coming. The confidence in fiat is going to ultimately explode and burst. And that will be the end game. And when it does, gold's not even going to trade at 3,000. Gold's going to trade at 15 or 20 or $40,000 an ounce.
How far away is that reality for you?
I don't know, and none of us do, right? We're just looking at the slopes of curves and the derivatives and so on and so forth. It feels to me like it happens within a 5-year window. It feels to me like the pace is quickening with each thing. I mean, we had the 08 blow up, you know, now, so it's 12 years to this one. Maybe they'll get this contained. I don't think they can blow a bubble at a higher level.
Yeah.
I mean, you know, there can't be a Mars bubble, right? So I feel like they will keep hitting the guardrails here, back and forth, inflate, deflate, inflate, deflate, inflate, deflate, and more people will kind of move into our stuff. And as our stuff gains more and more momentum, they'll have a real problem. If you kind of look at the 70s market as an example, you know, remember gold was $35 in 71. It ended the decade at 800-ish. You know, it went up and it did a midpoint correction, which we've already had. That was what happened from 2011 to 2015. So now we're in the next wave up, and you know, it's gonna get going faster, is my estimation. So I would say at the outside it's 5 years. It could be sooner. It could be a little longer. But I think that eventually this system is going to completely blow up. And that if we don't have, if individuals haven't protected themselves with real assets and sound money, it's going to be very financially difficult for them. And I think it's really sad, but it just is what it is.
Lawrence Lepard, I always enjoy speaking with you.
Oh, thank you, Danielle. Yeah, you're great at doing this, so I appreciate it.
Thank you. And thank you for giving us a sneak peek. You're a speaker at the upcoming New Orleans Investment Conference. Greenspan was there 1 year. So
was he really? Oh,
you don't know. Powell make a special appearance and come find you.
I don't think you'd be welcome.
But thank you, Lawerence. Always a pleasure. And
likewise. Thank you, Danielle.
Thank you. And thank you all for watching this edition of StansberryInvestor.com. We'll have more for you in the meantime. Don't forget to sign up for premier content at DanielaCambone.com. That's it for me. Thanks for watching.